In business succession planning, we've discussed there's 5 core options that are available for transitioning your business. First is transition your business to your family. Second, to your key employees. Third, sell it to a strategic buyer or a competitor. Fourth, a private equity or a financial buyer. Or fifth, an ESOP, an employee stock ownership plan. We were then talking about taxes, tools, and trusts. This video is going to focus more on the tools that are associated with succession planning. So some of those tools that your advisors will come to the table with would include stock recapitalization, the use of different qualified plans, distribution planning, and stock discounting before gifting. So let's talk about stock recapitalization. It's as simple as this. You can actually take a share of stock now and separate the voting rights of that stock from just the value. And if you're going to make a transition or sell some of your stock to, let's say, a key employee or to a family member, you can sell stock or value in your company without voting rights, which allows you to retain all control over some period of time or now and forever, and transition control at your death or transition control in 5 or 10 years. So stock recapitalization is a very common tool that people use in succession planning in order to retain control before they transition the totality of their business. The second is qualified plans. So oftentimes business owners are saying, I'd like to transition this business, some or all over a period of time, to my key people or to family, but I'd like to get paid for that and I'd like to accumulate money or capital for the future, 5 or 10 years from now. So one way in which we can structure a transition would include adding a qualified plan to your company, which would allow you to take money out of your profits before taxes from your company through fully funding a profit sharing, a 401k, and a cash balance plan. Cash balance plans are really a wonderful approach to take out an amazing amount of money from your company on a before tax basis, but it's not a good fit for everybody. Your census has to look right, your compensation structures have to look right, but it's worth at least a conversation with your advisor team if you're going to evaluate that. The third is in distribution planning. Oftentimes, when you're modeling out a succession plan, you think about taking the company earnings and the earnings after you make a sale of some of your stock, maybe non-voting stock again, those company earnings, and distributing it based on the ownership. So let's say you sell 50% of your stock to your key people. And at the end of the year, you have $1 million of earnings and you distribute $500,000 to your key people and you keep the other 5. The 500 that went to your key people, they could then use that money after tax to go back and buy your shares. So distributions are oftentimes modeled into the future to support a note payment or a payment plan associated with buying your business. The last is stock discounting. So in the tools, we think through a way in which you would discount your stock before you transition it, normally in a sale to a child or in a gift to a child or a trust for the child's benefit. It's the way in which you remove stock from your balance sheet and transition it to another. If you can apply a discount appropriately, that's usually by a team conversation with your accountants and your estate attorney. It's just a technique that I think is really widely used and important to evaluate in transitioning your business. So in the taxes, techniques, and trusts, I think it's a really important part of planning. And planning is always best done when you do it early and well in advance of the actual trigger date of transitioning your business. If you'd like to learn more about planning and planning for transitioning your business, please visit us online at legacy-online.com. Thank you very much.